But it's my great pleasure to be with Michael Hsu, who's been the acting comptroller of the currency since May 2021. Prior to that, many of you knew him from his great work at the Federal Reserve in bank regulation. Prior to that, he served at the Treasury Department and the Securities and Exchange Commission, and like all of us, got sucked into the financial crisis and the Troubled Asset Relief Program at the Treasury Department in one way, shape, or form. So it's really an illustrious career in multiple facets of government, which really prepare you well for your time as comptroller, where in addition to regulating 1,200 banks with 70% of the banking activity in America, you serve on the FDIC board, you serve on the FSOC Jedi Council of Regulators, and you have multiple responsibilities. So it's been, a year and a half. You've had all these responsibilities. What's your big takeaway so far?
So first of all, thank you, President Harker, Philly Fed, for sponsoring this and inviting me here. I wish I had Jedi mind trick skills to go along with the Jedi Council. That would be really useful. Maybe I can test some of that out today. Takeaways, there's a lot of change going on. And with that change, I think the real key is making sure we don't forget the lessons of the past. And I think there's a lot of lessons from prior crises. I would say that the number of us in the room who were around in 2008, 2009, it's shrinking. There's fewer and fewer of us. And I think it is very important that we have that muscle memory of what led up to that and just keeping our eye out. I'm sure we'll talk about some of that here. And at the same time, looking forward, things are different. And so we don't want to just kind of fight last year's war. And so kind of having this mix of experiences, and for me, constantly is just getting lots of different perspectives on whatever the hot topics are, whether it's crypto or fintech or any other developments, just so it's tough to calibrate, and that's really important to do that. And having been at a lot of different agencies, I'm very, very sensitive to regulatory arbitrage. Like we have a complicated financial regulatory framework, and on its best days, that complication is really good because it allows kind of specialization and focus on different things. On its worst days, it leads to unlevel playing fields and arbitrage and things falling through the cracks. And so we just constantly need to be vigilant about making sure we're leveling that playing field, we're working together on those issues.
So one of the priorities that you've listed has been digitization at the OCC. The amount of paperwork as we move into a 21st century regulatory system, fintech, regtech, subtech, there's all these different techs. But what has your experience been in the OCC's digitization effort? What have you accomplished? Where is it headed?
So what's really interesting is that this is happening everywhere. And so if I can draw an analogy, I think what digitization is doing to banking is somewhat similar to what globalization did to manufacturing. And by that I mean lots of different parts of the banking stack are being competed through technology. And in many cases, that's good. It's competitive, it's providing better things, faster things, et cetera. But what's happening is that banking, this provision of banking services is now being done by a bunch of different sets of hands. It's not just one institution doing it. It's one institution that's also working with fintechs and other partners and vendors, and they're working with vendors, and they're working with vendors. So you're ending up now with increasingly, I think, an outsourced, subcontracted, supply chain driven provision of banking services. And that has safety and soundness implications. We have to think about what does that mean for trust, ensuring trust in the banking system. It's different. It's different than what's been in the past. And I think that this is something that is not getting, I think crypto is kind of sucking the oxygen out of the room in terms of time and attention, and this issue requires a lot more thought, because it's not as simple as bank has one service provider and you deal with that. It's getting way more complicated, and I think it's that trend is going to continue.
Well, let's explore that metaphor for a moment, because when you say it, it kind of jumps out at me as one, making a lot of sense, but two, we moved into manufacturing to a just-in-time system. Yep. Huge cost savings, huge efficiencies. I might even speculate it helped lower the structural rate of inflation, which for most of the last decade pre-COVID was below 2%. But as COVID showed, it created a fragile system, right? And so while it was hyper efficient, it was not very resilient. And when you rebuild a system and you focus on resiliency and redundancy, it's almost definitionally less expensive, less efficient, and more expensive. But in the world of banking, is that analogy? Do you see that analogy also, that this type of third-party outsourcing digitization creates a fragility?
Yes, absolutely. Because for a couple different reasons. One is that who's accountable for what? So if things break, who is accountable for what? I think that's if it's all done in an integrated fashion by one entity, that's easy. Right? You're just pointing, and I think we're used to that in banking, that you regulate the bank entity. You've got a governance structure, you've got 3 lines of defense, you've got risk management. So that's a known way of saying, how do I identify weaknesses? How do I remediate those? If those are being now split by different parties for different parts of the process, how does that play out? Second, the business models are different, right? In banking, it's a pay-as-you-go business model. You kind of earn your cost of capital with those things. Technology is different. The technology business model is different. And so how do these things interact? And again, I like to use analogies. It helps to kind of, sometimes it can help kind of clarify things. Traditional banking is take deposits, make loans. When securitization and the development of capital markets came about, you had a fragmentation of that set of activities into a bunch of different slices, and the business model mantra was moving, not storage. That's what you heard back in the early aughts, late 90s, early aughts. That's what securities firms, trading firms did. And that ran parallel to banking. And I think for a long time, it grew rapidly, and there was a sense that, oh, that's separate. Banking is banking, and that's separate. And then in 2007, 2008, we learned, actually, they're completely, totally intertwined. And when one collapses, the other is going to be threatened. So how do we not repeat that analytical mistake now? I think that that's part of the challenge now, is that with this digitalization, it's almost there's echoes of that. It's different. It's not credit and liquidity intermediation. It's process. It's operations. It's payments. It's user interfaces. It's data. All of those things are now being kind of subdivided. How do we make sure that that's done in a safe and sound way for the customer? I think that's the challenge we have now, given our current authorities and how we approach things. And I think that that's something that we're going to have to update how we think about third parties, banking as a service. There's a whole range of things that I would love for this conference to attack and approach and kind of get the best thinking out there on it.
Well, let's stick with that third-party concept for a moment, because in the fintech world, if we travel back in time, as you were thinking, there was this feeling like 10 years ago that banks were allowed by their regulator to partner with a couple third-party folks, and only kind of a few banks wanted to play in that space, so that created a limited number of spots. And I would go to fintech conferences and have all these companies pitching all these fantastic ideas, and they were fighting for what they felt were a limited number of third-party spots that banks would only work with, and it constrained the pipe of fintech being developed. Now you kind of look at it, and it's a plethora of explosion of products being advertised on television, some with the word bank in them, some without, some subject to regulation about their use of that word, from who to the consumer thinks this feels like a financial services product, right? And then there are a couple banks, smaller banks, national banks, who seem to have specialized in banking the fintech. And, how do you agree with that analysis of the change? And 2, as a regulator, how do you think about regulating those handful of banks that have gone all in on fintech versus that set of banks that have stayed fintech wary, and what their future looks like? Because somebody's going to be right and somebody's going to be wrong, which is a good outcome in a marketplace, but a different outcome for a regulator. So how do you think about all that third-party stuff?
So I think your original articulation of the change is right. I think you see this. You just don't have to look further. There are these decks floating around where you've got 50 different logos of the different players in the space providing different services, doing different things. So that I think is somewhat reflective. And there's a lot of VC money in that space. And valuations are high, lots of unicorns, that kind of thing. So clearly, that has exploded. And then in addition to that, you've got the big techs who are also making forays into financial services, typically through payments. Like a lot of this is like the payment portal, because that kind of makes sense. You're dealing with a customer. So how do you facilitate a payment? But it's expanded from there. And I think that it's just across the entire stack of services, you've got technology firms who are offering ways to do it better, faster, cheaper, because scale is important. Data is important, scale is important. So I take those as given. I don't think it helps or makes sense to kind of fight gravity on those kinds of things. Then you fast forward and say, well, where does this go? And I think it's not just a binary, are you for or against? Are you using or are you providing a service? It's actually a richer landscape, and some of it's quite complicated. And so right now, this is evolving. What we're doing at the OCC is really trying to subdivide this space into, okay, what kind of relationships entail what kind of risks, and where banks have to provide need to do a particular kind of due diligence, et cetera, to ensure safety and soundness. And where is that different? And I think it's good to start with the bookends, and I think that you laid that out well, right? At one end of the spectrum is just traditional, contract out with the cores, provide back office. The bank is the customer. The cores are providing that particular service. At the other end, it's inverted, right? The fintech is doing the customer-facing activity. The bank is providing the back end. And in the middle, you've got a whole range of things in the middle. And this is evolving, and this is not going away. This is the future. And I think that this is what we, as supervisors, really need to get our arms around. Again, banking, the confidence part is what's really, really critical from my perspective as a banking regulator. How do you ensure trust? And in trust, as these systems evolve, the trust model is going to be different. And again, when things break, who's responsible? How do you ensure that those things aren't going to happen again?
And from a regulatory perspective, how do you handle that small group of institutions that are all in, that are essentially the back end for a bunch of customer-facing fintechs where you talk to the customer and they tell you their bank is actually a fintech, right? And then these banks out there are doing all of that. That seems like a radically different regulatory challenge than dealing with the traditional folks, yet you have the staff that you have, the people that you have, the structure in place. How do you guys think about that?
I don't know if it's radically different. It does require, I think, a bit different approach in terms of how you think about responsibilities. But I think the objectives are the same, right? The objectives are, so you want safe and sound system, you want fairness, and you want a level playing field. And so if you start with those principles, then you have a lot of tactical questions about, okay, how do we get there? What are the various paths of things that can break and can go wrong, and how do we address those? And so, the good news is the overall objective functions, I think, are the same. The challenges are, well, how do you deal with kind of the rewiring of these things so that you can achieve those objectives? And I think that there are some challenges there for sure.
So staying on this concept of what the OCC is doing, you guys have talked about some crypto sprints. And I think, for a while I thought it was kind of easy to poo-poo these things as regulators talking about things that they're doing, right? But in point of fact, later on from Treasury and other experiences that I've seen, these sprints, these exercises, these simulations can have profound consequences for how agencies think and prepare. Mm-hmm. And they're far more important than at one point I ever gave them credit. So where are you on this crypto sprint that you guys have announced, and where is everybody?
Sure. So I think the really important part is to note that there's just a lot of coordination and communication. So I take out the word sprint for a moment. What is this activity that we're talking about? It's about the agencies working together as a single, as much as possible as a single team to understand what is going on, what are the priorities, how are we talking about it, what do we need to focus on, and just having that constant collaboration and discussion. That's the core of it. Because the alternative would be each agency on its own has its own little team that does its own little thing and develops its own view of the world, and later on comes together and says, hey, what are we going to do now? That model works for certain things. It doesn't work in this space. I think in this space there needs to be constant, what are you saying? Hey, this thing happened. How do you view that? We're approaching this. How do you think about the safety and soundness of X, Y, or Z? So that exercise was structured that way. Now, the word sprint, I think, just to put that in context, that was stood up when crypto was on a rocket ship of growth. 1 trillion, 2 trillion, 3 trillion. So there was a necessity to sprint just to keep up. That's not the case right now, right? So some of the air has come out of that. And things are, last I checked, it's about $1 trillion. It's been bumping around $1 trillion. And I think that what that allows us to do is to take our time, a little bit more time, to be deliberative and very clear about, okay, where are the priorities, about what we need to make sure that anything done in the banking system is safe, sound, and fair. That's really, really critical. I think it's noteworthy that you had the Terra Luna implosion, you had a lot of contagion within the crypto industry, right? Celsius, 3AC, Voyager, et cetera. You did not have cross-contagion to the banking system. Why is that? Well, that's because I think we were quite deliberative as federal banking regulators to say, hey, you banks, if you want to do this, it's got to be safe, sound, and fair. You have to show us that it's safe, sound, and fair if you want to do this. So at the OCC, we had issued an interpretive letter, 1179, last year, telling all national banks, if you're going to do that, you have to demonstrate to us, and you have to get a supervisory non-object if you want to do that. With exactly this in mind is that we're not against the activity per se. What we're against is doing things in an unsafe and unsound manner, because we've seen this before. And I think, Aaron, to circle back, I am permanently scarred by 2008. I'm permanently scarred by, I was at the SEC from 2004 to 2008, and that was just the rocket ship days of derivatives. Everyone was getting into derivatives, capital markets, securitization. That whole ball of wax was very, very exciting, was very profitable, and there was always a fear of missing out. You had institutions that were not necessarily, that was not their bread and butter, and they got into it in spades, not safe, sound, and fair, got out over their skis, and you had a lot of contagion between entities and markets and things that should not have been connected. And so those lessons are being applied now. We're trying to do that through policy. Take a careful and cautious approach. Let's do this careful and cautious. If you can show us that it's safe, sound, and fair, great, but you have to show us.
So sharing scarring stories, I'm permanently scarred by the same thing. I was sitting in the Senate Banking Committee. I remember in 2006, your prior and all the regulators sat in front of and testified, and their message was not a single bank failed in 2005. It was the first calendar year in American history without a single bank failure, and how safe and sound the banking system was because we'd regulated away failure. And I remember thinking to myself, what if I came to Philadelphia every year and every restaurant was the same? Not a single restaurant failed. Is that capitalism at work? Is that something to be happy about? And of course, we know that there was no point where there was more risk in the system than when there was no failure. And the regulators couldn't have been happier that they'd done a great job. So on that note, and let's get into, let's put the softballs away and have some harder questions here. Right?
What time is it?
Yeah, last week, I asked CFTC Chair Benham whether crypto was a clear and present danger to the financial system. Do you think it is?
So here's how I think about it. Financial stability risks is all about contagion, right? That's the problem. You have one problem somewhere and it spreads everywhere. There's two contagions we need to think about with regards to crypto. The first is a contagion within crypto. And if you go before the Terra Luna event, I think a lot of the crypto enthusiasts were saying, this industry is great. It's super transparent. You can see everything. This is all above board. It's better than the regulated sphere because it's all super, super transparent. And it turns out that's not the case. It was actually, there's quite a bit of lack of transparency, quite a bit of leverage, quite a bit of interconnectivity within the crypto universe itself that led to lots of surprises. Like trust and contagion come down to surprise. How much surprise is there? If there was a meter for that, that's something to watch. So that's one form of contagion you have to watch. The second is what I talked about before, is cross-contagion. The contagion from crypto to banking. And so far, I'm constantly knocking on wood, that has been limited. Now, I think to your earlier point about 2005, I am constantly paranoid. That's part of the job. Part of this job is you want me to have a constant degree of paranoia on these things, because even though it's at 1 trillion right now, 1 trillion doesn't mean that it's financially stable forever. Things are constantly changing, and it's those two dimensions we have to watch. How much contagion. It's almost like a PD LGD. For the bank nerds in the room, this is like a PD LGD thing. Contagion within is like PD, probability of default. Contagion across is like LGD, right? Loss given default. And so we constantly need to watch those things, and that's where the financial stability risks are.
So you said in a prior speech, quote, contagion risks are real on crypto. Quote, crypto is highly fragmented and prone to hacks, end quote. You also said hype is not harmless, which, to flip the double negative, hype has harm. That wasn't your exact quote, but I think that's a fair interpretation. So is this a clear and present danger?
So I will reinforce all of those things. Crypto is fragmented. There's some great research put out by the BIS which shows there are some structural features of crypto having to do with congestion, the way things were just set up. So instead of having network effects, winner takes all, it's just more and more and more fragmentation. That's a structural issue, which I'm not sure the crypto industry has quite grappled with. Hacks, I mean, every week, like last week, there was just another hack, I think by Nomad, the most secure cross bridge, happening again and again. Again, I think this is a structural problem that needs to be dealt with. And then hype is not harmless. It's a hype-driven economy. And I think this is something that some in the industry are starting to grapple with. But I think that this is something that's it's a real, as long as those pressures are there, financial stability risks are going to be something I think about.
So we set up a structure in Dodd-Frank with the goal to empower the regulatory perimeter to expand and handle it. We set up this council in FSOC on which you serve with a set of tools designed specifically so that you wouldn't wake up one day with an AIG on your hands and have these crises, right? But I'm a Star Wars nerd to some degree, and I'm right. The Jedi Council lost, right? The Emperor beat Yoda. All the smartest, coolest Jedi sat around in a room, and they didn't see the threat that was right in front of them.
What do you mean for this?
Like, we're on like 17 Star Wars, right? Like I'm an OG one. But what I want to know, right? And in fact, one of the things I remember hearing was the risks were outside of the banking system, particularly with something called structured investment vehicles or SIVs. And for those of you who
having PTSD now,
yeah,
thank you, Aaron.
There was a thing from Treasury Secretary Paulson way back when, the super SIV that was going to save all the SIVs, and essentially, a bunch of risks had been put off of the insured depository institution. But when they started to fail, there was reputational risk, there was run risk, and there was a feeling that the institution couldn't leave them off the balance sheet and let them suffer and had to instead bring them on the balance sheet, which drained their capital. So 1 minute as the bank regulator, like, oh, the bank's in great shape. Oh, there's this other thing, it's off balance sheet. Oh, wait, now it's on. Oh, wait, we have a problem, right? And nobody talks about the SIVs because we all forgot them, right? Because bigger things happened. And then I see all these things about stablecoins. We're going to have a stablecoin issuing system. It's going to be outside of the system, right? There's all this legislation floating, and I want to give you time to comment on, Loomis Gillibrand, the draft ideas between Waters and McHenry. There's now a Stabenow, Boozman bill, I think. All this stuff is going. One, do we need new legislation? Are the tools we have sufficient? Two, of the legislative proposals out there, what do you think makes sense, and what has you a little more concerned?
So I say legislation would help. Depends on what the legislation is, but legislation would help. I'm not going to talk about any specific bills. The OCC has been, we've been consulted on a lot of these things for technical assistance. So let me just share how we've been responding to those requests, just at a high level. First, for a stablecoin, it's got to be stable. So I think there's broad agreement that if you're going to call it a stablecoin, it's got to be stable. And I want to be extra clear on this. Not stable sometimes, and not just stable usually, always stable. I think that's very, very important. And so if that's the case, then I think there's broad consensus. You have to have high quality assets in the reserve. You need a prudential regime. These elements, I think, are not super controversial. I think that there's just general consensus around that, but we try to make sure that the details around that are right, number one. Number two, the activities of the issuing and redeeming entity need to be limited. And this I also agree strongly with, is that it's not a money creation machine. It's there to issue and redeem stablecoins. limited purpose. And I think that that will help ensure that over time, it serves its intended function, which is to provide a stable coin. 3, it needs to be interoperable. And by this is, I think, something that has not gotten as much discussion, but if it's gonna function like money, if we want to avoid creating a free banking era with modern, and Aaron's smiling because for the econ history nerds, this is a very important point. The US banking system pre-OCC was very fragmented in terms of how the money worked. And so the stable coin, if we can devise something from scratch, let's not revisit the fragmentation and all of the challenges and the frictions associated. Let's make it interoperable. Very important. 4, separability. This gets back to the contagion point. Stablecoins, crypto, it's a different technology. There's a different set of risks. Until it matures, you don't want to commingle it with traditional banking and finance. You want to maintain some separation. And then lastly, level playing field. There's lots of different ways to charter and license and who has what. I'm very, very sensitive to the fact that if you distribute the authorities too broadly with too many options, it can really lead to a race to the bottom. And as long as there's even standards and a level playing field, you can have multiple parties, multiple jurisdictions at the party, but that's very, very important to maintain. So this is the kind of feedback we've been giving on various proposals.
So I'm seeing time that there are a million ways I'd love to follow up on that one, particularly pointing out the OCC's creation by my favorite, I'm a big Democrat, but my favorite Republican president, Abraham Lincoln, created you guys. But it was created out of a crisis, right? State banking didn't work very well when some of the states tried to leave the union. And whether Congress can regulate before a crisis in a situation. So I encourage you to really think about the tools that you have while you're working to get new tools and satisfy your principles. We can't leave this conversation without talking about financial inclusion, because you said hype is not harmless, and I feel like we talk so much about financial inclusion, and then I ask myself, what really is being included? Are we building more tools, right? We have the 5% of Americans who are unbanked, but more than that, we have 15 to 20% of Americans who are banked, who use check cashers. My research has shown 70% of people that use check cashers have a bank account. Why are you paying $20 to cash a check when you have an account that would do it for free, but it would take multiple days? Real quick, because I'm getting the time thing. What's your view on how fintech, crypto, stablecoins, all this stuff is living up to the hype on financial inclusion, or is not, and creating harm because we're pretending that a technology is going to solve our problem, which makes us feel better at night when we rack up our credit card rewards and pat ourselves on the back? And don't actually deal with the structural problems about why it's so expensive to be poor in America and how much financial services contributes to that.
So I'm going to make a plug for Aaron's research that he had published on financial health, which I think you did an excellent job of summarizing how it's expensive to be poor in the financial system and what can be done. And in that, crypto is not the answer in that particular thing. But let me go back for a second. Good news. People are talking about financial inclusion. That is excellent. The fact that companies are putting that as talking point number 1, 2, or 3, sometimes all 3, as to their pitch, I think that is fantastic. They need to be held accountable to it. Show me. Show me how what is being offered is inclusive, and inclusive for what purpose? This is really, just having access to something that you can gamble on that does not constitute inclusion. How are you improving the financial health of people? Helping them save, helping them build wealth, helping them plan for retirement, helping them to meet paying their bills. Those are things that are very, very valuable. And I know there are people out there working on that, and that should be applauded. My one concern now is that with crypto winter and with kind of the down rounds in fintech funding, I think there's now a real focus on, used to be customer growth. And so in that growth, you could kind of shoehorn in inclusion into the growth. I think the story is changing now. The story is now about profitability. It's about unit economics. Where is inclusion in that? And I think now is really where you've got to step up and just, now you're going to prove whether or not this is a talking point or whether this is something that's really important and a priority. If it's a priority, that is great. And I think that at the OCC, we've got a whole bunch of programs on inclusion, and I welcome engagement. This is something we feel pretty passionately about. And I think we want to move towards a system where we have a better finger on the pulse on the objective function so that we know whether we're driving towards that or not. And I think that really is about the financial health of those unbanked and underbanked.
Excellent. Well, thank you very much. Join me all in thanking Comptroller.